All right, so next we want to talk about the termination of a partnership as well as liquidation of the partnership. All right, so liquidation requires normally 3 steps. The non-cash assets are sold and the gains or loss on the sales are allocated to the capital accounts of each partner on the basis of their profit and loss ratios. 2, the partnership liabilities and expenses are paid out of the partnership's available cash. And then any remaining partnership cash after paying liabilities and liquidation expenses is distributed to the individual partners on the basis of their respective capital balances. And so the accountant's job is to summarize and keep track of this process. Accountants do this through what's called a statement of partnership liquidation. It's kind of like, if you look at it, it's kind of like the report that the trustee did when we discussed bankruptcy. Now, usually this is pretty academic if you have plenty of money to go around, but there can be complications because there can be negative reasons. Many times there's negative reasons as to why the partnership is terminating and liquidating. And so it can become more complicated if one or more partners have negative capital balances, and somewhat more complicated is the fact that the liquidation may take place over an extended period of time. Kind of like what you saw with bankruptcy, though, the partners don't necessarily want this to take a lot of time, so they may not wait for the best and highest price for the non-cash assets that need to be sold. So they're looking for the best price under the circumstances at the quickest point. And so one of the things that the accountant can do, because certainly the partners, especially those that are have positive capital balances, might want to get some money. And so what the accountant can do to get them some money is to pay them a distribution of cash, what we call safe payments. So we'll look at that. And the good thing to do would be, especially if this is going to occur over time, is to create a cash pre-distribution plan as well as a statement of partnership liquidation. And so the cash pre-distribution plan would just be an indication of what the accountant believes will be the cash after the payment, or excuse me, after the sale of non-cash assets, and then take that cash to pay the liabilities, and whatever's left over goes to the various partners. All right, so first thing we want to look at is an example here of how we determine the amounts to be paid to partners in a liquidation. And so we have Morgan and Houseman. They want to liquidate their partnership. The reason why is really of no concern. And the process calls for assets to be converted into cash to pay obligations and liquidation expenses. There are expenses that are going to be incurred to sell these non-cash assets, and so you have to account for that. That's got to be paid out of partnership cash. Any remaining assets are distributed to the partners based upon their final capital balances. And then once that's done, then the partnership books can be closed. Whoa. And so here, the partnership has $75,000 of non-cash assets. Morgan and Houseman allocate their profits and losses on a 60-40 basis. And so we've got accounts receivable, inventory, and land that make up that $75,000. As of this date, Morgan has $50,000 of capital in his capital account, or hers, and Houseman has $38,000 in his or hers. And of course, we have liability of $32,000 and cash of $45,000. Certainly, they have enough to pay off the liabilities already with the cash they have, but they still have to sell the non-cash assets to satisfy the two partners, plus the 13 excess in cash. And so here are some entries based upon some additional facts. And so on June 1st, the inventory is sold for $15,000, and the inventory on the books is $22,000. So there's a loss on the sale of the inventory. Notice here that the loss goes directly to subtract the partners' capital accounts based upon their split of profits and losses. And so, of course, you're going to recognize the receipt of the cash of $15,000, and instead of recognizing a loss on the sale, you're taking that directly to each partner's capital account and allocating the loss based upon the profit-loss ratios, 60-40 in this case. So Morgan gets $4,200 of the $7,000 loss, 7,000 times 0.60, and Houseman gets the other 40%. And of course, you credit your inventory. All right, so another fact they put in here is $9,000 of accounts receivable is collected. The original amount on the books is $12,000. And so we have a $3,000 write-off, And so that loss is allocated 60-40 between Morgan and Hausman also. And so you acknowledge the cash by debiting $9,000. Morgan takes $1,800 of the loss, and Hausman takes $1,200. And of course, accounts receivable comes off the books. The fixed assets on the books at $41,000 are sold for $29,000. The loss of $12,000 is allocated 12,000 times 0.60, 7,200 to Morgan, 4,800 to Hoffman. Whoop. And on top of that, there are $3,000 in liquidation expenses that they have to incur. And so that has to be taken directly to each partner's capital account as well on a 60-40 basis in this instance. So credit Morgan $1,800 of the $3,000 liquidation expenses and $1,200 to Hausman. Okay, so all these entries, all these losses are causing Morgan's and Hausman's capital accounts to be reduced. And in some cases, it might be reduced to a negative amount. In this case, that's not true, but it could, as we'll see in some other examples. So after it's all said and done, what you've got is, after paying, after selling non-cash assets, paying the liabilities, paying the liquidation expenses, there is $35,000 left in Morgan's capital account. Hausman has $28,000, and of course you have the total of that sitting there in cash, and so you simply debit Morgan's capital account for $35,000, debit Hausman's capital account for $28,000, and you're going to credit cash, and that's going to close out your financial records for the partnership. So that's a nice and easy example when things go smoothly. And, again, it's going to be pretty common to see a bunch of losses. Not sure how common it is. You end up with all those losses and the partners still have enough cash remaining to pay off completely their capital accounts. But anyway, it's a nice thought. Now, these liquidations can take a lot of time. And as a result, the parties involved, creditors, the partners, want some idea on the progress of the liquidation as it goes along. And so this statement of partnership liquidation is meant to hopefully placate all parties. And so what it does is it lists the transactions to date, the property that's still held by the partnership, any liabilities remaining to be paid, and the current cash and capital balances. If you look at Exhibit 15-1, that looks very similar to what you saw in the trustees report on liquidation in bankruptcy. Very similar format. Now, the partners may experience deficit balances during the liquidation period, and the partners may want a cash distribution, like I had indicated before, prior to the completion of the liquidation. And so, again, that boils down to the accountant trying to figure out the amount of safe payments that can be made to the partners. Now let's look at what happens when you have a situation where partners have a deficit capital balance, or they become personally insolvent. Because remember, when a partner becomes personally insolvent and they can't pay their creditors, those creditors can go after assets of the partnership. So, I mean, from a partnership, from a legal standpoint, I mean, the other partners are just really kind of bystanders, victims in this if one of the other partners becomes personally insolvent, because his creditors can go after the assets of the partnership. So deficit balances can be resolved in two ways. Certainly the deficit partner can pony up money to cover the deficit, but if that's not possible because, you know, he just doesn't want to, or she is insolvent and can't, then the remaining partners are just going to have to absorb the deficit. Now, do they have some sort of legal recourse against the partner who has the deficit? Well, yeah, but I mean, you know, if they're in bankruptcy, a lot of good it does to try to get it. As a matter of fact, remember, if one of the partners, if the partner with the deficit capital account is in bankruptcy, the partners can't do anything without the court's approval to force that partner to pony up money. And then, of course, you've got all the other creditors standing in line. So it's really, I mean, once bankruptcy's been filed, it's kind of hard to get that partnership or partner to pay up. All right, so we have this particular situation, and so here you have Holland with a negative $6,000 capital account. Dozier has a capital balance of $15,000, and Ross has a capital account of $11,000 balance. Now, certainly Holland could pay up, put $6,000 into the partnership. That brings cash up to $26,000. Holland's capital account is closed out once he pays the $6,000, and then the $26,000 can be issued to Dozier and Ross. So that would be the easy thing to do. Now here, you've got these partners. The allocation of gains, or excuse me, income and losses is based upon a 4-4-2 ratio between Holland, Dozier, and Ross. What happens if Holland doesn't pay up? Well, they're going to have to absorb the loss, and they'll have to do so on a 2/3, 1/3 basis. Dozier and Ross will, because of their allocation of 4 versus 2. So grand total of 6, so 4/6, or 2/3 if you will, and the other is 2/6 or 1/3 for Ross. Now here's an example of Holland just paying up, and then he gets his capital account to 0, so that closes him out. And then closing out Dozier and Ross, you simply debit their accounts and credit cash. So pretty easy. But then if he can't pay or won't pay, and Dozier and Ross have to absorb this loss, they're going to absorb it based upon a 2/3, 1/3 split. So Dozier takes 4,000. That brings his capital account down to 11,000. Ross's capital accounts brought down to 9,000. So that corresponds, those two balances correspond directly with the amount of cash that's left. And so at that point, a safe payment can be made of 11,000, and 9,000 to Ross. Now you could do this even though, let's say they were going to not close out this account, the partnership books, because there's pending litigation going on against Holland to get Holland to pay the 6,000. I mean, what you could do, and what you have to do when you're considering safe payments, is you have to consider what the maximum amount of the loss would be that being absorbed by the remaining partners. Well, here the maximum amount of the loss that would be absorbed by Dozier and Ross is the $6,000. Okay, so based upon that, you could make a safe payment, the accountant could, even though the partnership books have not been closed out because of pending litigation. And you don't create any new deficits. Of course, there's not really anything left in the partnership, but you know, at some point they may have to absorb this loss, and they still have, well, Dozier would have 4,000 in his capital account, and Ross would have 2,000 in his capital account to absorb the $6,000 loss if the litigation proves to be unsuccessful. And so in this schedule of liquidation, figuring out interim cash distributions, you have to assume the following. You have to assume all non-cash assets will be complete losses. All liabilities will be paid, and all deficit partners will be written off. Okay? And so notice that these assumptions, at least 1 and 3, may be unrealistic. What they do is they allow for the computation of these safe balances, and thus safe payments can be made to partners with a positive capital balances. And so here's an example of our report of partnership liquidation. Note it's horizontal, and as new transactions occur, another layer can be added at the bottom. But notice this is a complete report that goes all the way through liquidation and closing out all capital accounts. Okay, so tomorrow I will do another lecture starting at page 679, but make sure you look over some of the other examples that they didn't include in this slide show. There was a couple of other examples. One is, what if the deficit is partly collectible? Same deal. If it's partly collectible, then you note the cash, like there on page 674. In that case, Holland paid $3,600. And then the rest of it had to be written off. On page 675, make sure you look at the example of what happens when two partners are insolvent. It's basically the same thing. And then the other thing is, well, what happens when the partnership is insolvent, meaning there's not any cash left and there's liabilities that must be paid and there's capital accounts that must be dealt with. What happens then? So make sure you look at page 676, 677, and 678.